Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody, to this edition of the REI Hacker Podcast. I'm excited for my next guest. His name is Shawn George. Shawn is the co-founder of Limitless Real Estate Fund. It's a 506c Reg D real estate fund that's focused on residential new construction and land development across the U.S. Shawn's got over 15 years of experience in technology and real estate. Shawn's currently developing over 90,000 square feet of housing in the greater Seattle, Washington area. Very impressive, Shawn. Thank you so much for being here. I really appreciate it.
You're most welcome, Benson. It's a pleasure to be on the show, and thanks for the invite. Very excited to talk to you and your guests today, or you and your audience today, about new construction and what we're doing.
Yeah, I love it. I'm excited to get into it. You've been in the industry for a long time. You started off in the tech world, and I've interviewed hundreds of people for my podcast. We'll say I just broke 100, rather.
Awesome. Congratulations. Yeah.
Thank you. I appreciate that. And I can't tell you how many of them got interested in real estate because they read the Rich Dad Poor Dad book.
Sure. Yeah.
But I heard that you've said that you actually grew up in a Rich Dad Poor Dad household with parents that were, highly educated, but financially struggling. Can you tell me more about that?
Yeah, no, great question, Benson. Yeah, kind of as the book talks about, parents are both well educated. Dad had a, physics degree, mom had a master's in math, uh, very well educated. But I remember one of the most common topics in our household was just finances, and rather the struggle with finances. Someone's making a bad purchase or blowing the budget or whatever, right? And one of the most common sources of arguments between my parents was just that, just finances, as it is in a lot of households. And so I remember growing up scratching my head, how are we well educated, did the college thing. I actually went to two top schools myself. um and I think and then just wondering how we're all struggling for this thing that we're supposed to be able to get financial freedom through the quote unquote education system, which there's obviously benefits to it. I was actually
Yeah.
pre-med for a while. I was on the pre-med med school track, and then organic chem 2 happened, which was a whole nother story. Not the most fun class in the world, but realized, that there's, long story short, our university and college system is great. But they educate you for jobs, not for financial freedom, and they're two very different things.
Yeah, it's true. And, that blueprint, go to school, get a good job, you get a pension. Even if you do it right, it doesn't always work out the way it's supposed to. And, especially people who are in middle America, where, they're not coming out with these degrees that pay a lot of money. They're still kind of, middle America. And, they don't always get these, I don't even know, retirement programs, pensions, 401ks. So they're even struggling worse. But you started to realize, even having some of these things like a 401k and a retirement benefit plan with Microsoft and some other, really, really good companies, that you didn't see a good path to financial freedom. And, where was it that you realized that you could see more benefit, more return on investment by setting money aside through other vehicles besides just the traditional retirement plans?
So yeah, Microsoft. So I started at Microsoft in 2011. Did my faithful 401k match. Got I think it was 6 or 8% that Microsoft was matching at the time. And fast forward a couple years later to about 2017, 2018, still at Microsoft, and I took a look at our 401k account, and there was a few $100,000 in there, not a bad chunk of change, right? But then I took a look at our real estate portfolio. And my wife and I had started investing in real estate. We bought our first townhouse in 2015 in Southern California. And then we bought one or two more condos, or single family homes. I compared our two portfolios, the 401k against the real estate portfolio, and realized that in half the time, my real estate portfolio, thanks to appreciation, and rental income and all that, was over twice the value that was in my 401k account. And I've been investing in my 401k account for 7-8 years. And in less than half the time, in about 3-4 years, my real estate net worth was twice, if not three times as large as my 401k portfolio. So I was like, wait a minute, light bulb goes off, right? And I'm like, maybe there's something more to this whole real estate investing thing. And it comes down to leverage, right? With a 401k account, you put $1 in, you get $1.10 out, right? Or some, say $5, $10, $15, whatever that number is. But with real estate, you have this thing called leverage where you put, $1 in, you get $4 out, right? Because you're leveraging that capital. And then the growth is on a much lower basis than with a standard stock or investment portfolio. So, not rocket science. Others have figured this out as well,
Right.
but it's something to actually experience it yourself, right?
Look, and imagine when you first saw that, you must have thought, okay, this can't be right. Like, why is everybody doing the traditional route when there's these other paths here that seem so much
Yep.
more simple and, fairly straightforward. We're going to talk about some more advanced kind of strategies, but why aren't people doing real estate investing more often? I mean, it is within reach, and you don't have to go and, buy all these properties in expensive areas like Southern California. You could buy a rental property in the Midwest for 50 grand. So why do you think
Yeah.
that people aren't doing these strategies?
No, it's a great question, Benson, and I think it's a multifaceted answer, right? But I think a couple major data points. Um, one is there is, a general, if you will, I think availability of these investments. Like you can go to a Robinhood or just go to your app store and download Robinhood.com or download your Fidelity brokerage app or whatever it is, and you can go buy a stock in 5 minutes. Right. It,
Mhm.
it takes a bit, but then to go buy a piece of real estate requires a bit more investment, a bit more investment of time and energy to figure out these things, right? And understand what's a good real estate investment versus a bad real estate investment. A lot of people know of the HGTV, sort of version of real estate,
Yeah.
but how do you vet a good sponsor or a good developer or a good flipper versus a bad flipper, right?
Mhm.
And so there is some of that stuff, and I think you just I think me and you, being fund managers, we're taking out some of that risk for our investors by doing that vetting, by doing that screening process, by doing the underwriting for all the deals that are in our fund. And so our investors can hopefully trust our expertise in that regard and do some of that screening for them, right? Obviously, every investment carries risk, just like a stock investment carries risk. A company could go upside down tomorrow, right? We've all seen the meme stocks go bust, right? As well. So there's risk to everything, but I think one of the reasons is that you know a lot more folks invest in stocks than say real estate, even though real estate's an amazing asset class and provides unparalleled returns, is because of just this availability or this access, I guess, kind of thing. Which I think funds like Limitless, like your fund, is bringing these more non-traditional returns and asset classes to the masses, so that all
Yeah.
of us can take advantage of it.
And that's one of your missions at Limitless, right? Is to help the average W-2 employee get that financial freedom that is so elusive. And that's such a pretty cool thing to get behind, right? Because a lot of people like to volunteer and they do things. I love volunteering. I volunteered throughout my life in different
Yeah,
ways,
same here.
but there's a different way to give back to people that can have more impact. And I think it's honorable to have a mission like Limitless has to help W-2 employees get that leverage that they wouldn't get otherwise. And, I've struggled with, talking about my fund and raising capital. And there's this little, guy in my head is like, oh, don't tell this to everybody. Like you're imposing yourself on others. And I came to a realization one day that, if I'm not sharing this with people, I'm actually doing them a disservice.
Exactly.
Like I really am not giving everybody the opportunity that they deserve. They're not getting this from the mainstream media. They're not getting this from their friends or their family. They're in, echo chambers and they're just hearing the same thing all the time. So it's my duty as a fund manager to help them and to share this information with them.
Yeah, yeah, well said, Benson. I think you hit the nail there, and I think yeah, in the tech world, I was in sales, and in sales, they'll tell you if you don't believe in what you're selling, it's very hard to make that sale, right? So, um, I'm glad you believe it. I believe in it too, and I'm someone who has a more of a profits for purpose kind of perspective. It's not profits or purpose; it's profits and purpose, right?
Mhm.
And I've met a lot of people, and I ask investors, people that I just interact with in general, and especially the ones that have the ambition to be rich or to have money. Like, what do you want to do with that money, right? And I've never come across somebody yet, at least so far, spoken to thousands of people, have not come across somebody who's said that they want to do something bad with that money. It's always something positive, right? It's I want to pay off my student loans. I want to buy my parents a house or my mom a house or something. I want to travel the world. I want to give to start this orphanage, a whole bunch, like a list of all positive things, like never a negative thing. So, you know, I do believe that, I do through my church and stuff, we do a lot of charity work and things as well. But, this idea of financial freedom, part of the light bulb for me, if you will, leaving my tech 9 to 5 was nothing against 9 to 5s. I think there's a place for 9 to 5s. I think it's great to have the Amazons and the Microsofts and the Googles and all that of the world, as well as all the other industries and companies that we have. But at the end of the day, we do have to realize, what sort of clinched it for me was I'm either working for somebody else's dream or I'm working for my own, right? We all have limited time. What do what do we each want to work on? And that's the question, right?
Right.
And so I think, having it's not a good or bad question. It's just how do you want to spend your time sort of question. And so
Mhm.
financial freedom allows, I think, more of us who have whatever purpose-driven missions to focus on the things that we actually want to do and care about with the limited time that we have.
Yeah, I definitely agree. And you kind of glossed over, you said this term profits for purpose, but you actually went out and started a nonprofit called Profits for Purpose.
Yeah, I did. This was a couple years ago. It was in Southern California. We were, and still are, in fact, taking a bit of a detour with real estate being, just kind of generating that right now with Limitless. But Profits for Purpose was the idea was to, and still is, to set up these profit centers that'll then go fund nonprofit work. So at the time we were looking at education. So basically setting up these schools in third world countries and being funded by revenue centers here in the States or wherever, right? But that was the idea, is just combining those two things, which sometimes can be uh, just contradictory, if you will, sometimes. So
Yeah. No, I think it's great that you're living, by the rules that you're talking about here. And you're not just, talking the talk, you're walking the walk.
thanks. Yeah.
And is but many years ago, I don't know how many years it was, but you switched over, your philosophy changed around, owning, passive income real estate, like rental properties, to doing new construction.
Yep.
What happened there? Is that just another epiphany you had about, okay, like I figured out that there's a much better way to earn money, and you can do some great things with owning, rental properties, I don't know if it was single family to multifamily, but now in new construction and land development, you're doing some completely different things that not a lot of funds are doing. What was that transition there?
Yeah, so going back to the story, I guess, 2018, 2019 timeframe, wanted to leave Microsoft or wanted to leave my 9 to 5. And, as mentioned, had acquired a few passive rentals, which sounded great. And there was definitely value there, as mentioned. It was two or three times my 401k account. Problem was they were all locked up in the properties themselves. So it was primarily appreciation game. They were not cash flowing, however. Big difference between
Mm.
cash flow and appreciation, or the property value, that Zillow value or that Redfin value, doesn't mean you're actually, getting to take home that 500 or 800 or $1 million equity, right? So unless you actually sell the property, obviously. So needed to generate cash flow, and basically the rentals we owned were on the West Coast, where the rents barely covered the mortgages, right? So there was almost zero cash flow. Right. So started looking at, how to generate cash flow to get this financial freedom, right? And basically, I think at the time, if we could make 10,000 a month passive income, that would be perfect for my wife and I, right? At the time, it was just the two of us. Now I've got 4 kids, bit of a bigger household budget, but back then it was just two of us. And if we could generate 10K a month passive income, that'd be awesome. So we started looking around. We looked at Airbnbs, we looked at assisted living, we looked at putting an ADU in our backyard, we looked at, multifamily, looked at fix and flips, rehabs, house hacking, the whole 9 yards, right?
Mhm.
And thing we realized is, at best, they're returning, and not to knock these operators at all, but they're returning between 8 to 12%, depending on the fund, depending on the structure, so on and so forth. Which is great if you have a million, 2 million bucks to put into it, and then if you're earning 10% a year, you're making, say, 10 to 20K a month. But we didn't have 2 million just lying around, right? We um that was the problem statement, was just not having the initial capital to put into these more or less passive investments. So that were just earning 8 to 10 or 8 to 12% a year. And then I kind of had a chance meeting at a local coffee shop with a local home builder, and he in fact owned the coffee shop up the street from us. And got to talking, just casually one day. Found out what he does. He builds homes in our neighborhood, and he and some local investors go in together. Local investor buys the land, he comes, builds a home at cost, and then they sell it and split the profits 50-50. I was like, huh, interesting model, cool. Never had encountered new construction before till this point. And I was just out of curiosity, I was like, so what ROI, or what return do your investors make? And he's like, 50%. And I thought he was joking. And I was like 50 or 15. And he was like 50%, 50. I was like, in what time frame? And he was like, in about 2 years, some even less. And I was blown away. I mean, I'd never heard of 50% returns in real estate, before, in 2 years, like maybe 5 years, but not 2 years, right? And
Yeah,
then and that was 2021, and I was hooked, and then we started our first project together. It was a 5 home project in 2021, and then we started the fund in 2022 to basically scale that model and bring, the benefits of new construction to more investors beyond myself.
that's crazy. Was it difficult leaving what you knew already and transitioning into something brand new that you didn't really understand, or was it you just read a little bit and figure it out pretty quickly?
Um, yeah, no, it was definitely a bit of a learning curve, and I think definitely have some lessons learned. But I think, overall, the developer, or the local home builder I mentioned, had been doing it for the last 10, 15 years. So I was relying on his expertise and his experience and track record. So it wasn't a jump from that perspective. I had to learn new construction and the process of new construction, so I could
Mhm.
obviously speak to it. But yeah, it enabled that financial freedom, and I left my job I left that 9 to 5. I was doing it sort of as a side hustle for a little bit, and then left the 9 to 5 last year, about a year ago to this date.
Congratulations.
Thank you. Thanks,
Did
man.
did that take any convincing for your wife? Like, okay, honey, we're ready to move on.
Yeah.
She's like, no, that's secure. Like, we're not entirely sure that this real estate thing is going to work out.
Actually gonna work. Exactly. Yeah, man. And in that time we also had 4 kids. So yeah, it was a bit of a tougher decision. And thanks to inflation, things only cost more these days. But
Mhm.
yeah, we've been able to by the grace of God, been able to do well, and yeah, and we've been comfortable ever since. So, and that's really due to taking some of these bets with new construction and having those pay off.
Yeah. But hearing this story, it seems like you haven't had to make any huge pivots with what you're good at. Like you've always been selling, right? Your business development, building trust, selling products and services. You're probably not out on the site swinging a hammer,
I'm not.
installing trim and painting the house or
Yep.
even GCing it, right? Like you've got him to do that. So you get to use what you're good at in this new venture, which is probably going out and raising money, talking to people and
Yep.
about what you've learned, right? Through how, the education system isn't teaching you what you need to know.
Yep.
Um, and yes, W-2 employee, like you probably recognize that, your retirement isn't maybe all that reliable. And so there's an alternative out there. Is that what you're doing here? Is like you're just taking what you understand and you're sharing that information with your audience, which is these W-2 employees who probably don't know any better.
Yeah, that's exactly what I'm doing, Benson, is you're right. I'm not the one swinging the hammer. I'm able to, but it would just be a very slow house, or it would take forever to actually build it. Um, but yeah, no, exactly. Personally, what I bring to Limitless into our business is really just sort of evangelizing this whole new construction, I think, investment area and an asset class, if you will. I think it's interesting. A lot of people see houses go up and see buildings go up and see high rises go up and all these different buildings. If you drive around, there's a ton of construction here in the Seattle, in the Pacific Northwest area. But I think much fewer people actually know how they're built and how they even get there, and how do you get how do you get permits? How do you even get something out of the ground? Like, so just that whole process. And I come across a lot of investors who know, like they know, like a fix and flip, like they can see a house being remodeled on HGTV or in real life, or maybe they do it themselves, or they'll see a multifamily, like a B or C class multifamily getting flipped to be an A- property or something. But I think far fewer people know what the whole construction process looks like. And so I find myself spending most of my time educating people about new construction. And this stuff is actually not rocket science. Yes, there are challenges, with like permitting and zoning and um, city codes change all the time, whatever, right? But it's a relatively um, it's a relatively what do you call um, pretty straightforward process, and you're generating a large amount of value um, through new construction. So to give you an idea, here in Seattle, we're building at less than $200 a square foot, and we're selling at between $400 to $600 a square foot. So from an investment standpoint, great value generation that is also an inherent protection against risk and downside, meaning that our local housing market would have to drop over 30% for our investors to lose any of their principal,
Hmm.
which is pretty significant.
Right. Assuming that you can complete the project, right? Which is a
Of
big
course.
assumption, right? That's,
Fair.
somebody who's
Yep.
new coming in, they're thinking that like, what if this thing never gets built?
Yep.
But you've got the track record, right? You guys
Yep.
have done this before. This isn't your first project, right? So that's there to mitigate those risks and those fears of the people that are coming in who don't quite understand new construction.
Yep.
But you're only working with accredited investors, right? So you're already working with
Correct.
somebody who supposedly understands money. right? And they're just trying to figure out where to put it.
Yep.
Um, so tell me about some of these projects that you guys have worked on in the past and what you're currently working on, because new construction can mean a lot of things, right? It could mean, you're building single family houses in a subdivision, or you might be building a multi-family apartment building. Like what do these projects look like?
Yeah, great question, Benson. Yeah, so I mean, exactly as you say, there's so many types of new construction. There's commercial, there's residential. Um, we're focused on residential, so we do residential single family. And so our typical project is we will come in and, they may or may not be an existing structure or an existing house on the piece of land. But typically we're buying the land either vacant or with some existing older home on it. We'll tear it down and we'll build between one to as many as 15 to 20 homes per lot. It all depends on the lot size, right? So, for example, today we're doing, we are looking, we're basically, we just closed on a 14 single family home project here in Kent, and Kent is a suburb just south of Seattle. Existing, there's it basically large vacant, about a little over an acre of vacant land. We're coming in, building 14 single family homes over the next 12 to 18 months. We turn around, sell those homes, and provide the return back to our investors.
Hmm. So through that process, are you guys doing pre-sales and trying to get these homes sold before you even finish the project? Is that part of the goal?
Yeah, exactly. Yep, yep.
Yeah.
So we obviously close on the land parcel. We'll start foundations, framing. Typically, once we get to the drywall stage, is when buyers can really envision what the house is going to look like. So we list the
Hmm.
homes for pre-sale. We've got, renderings, 3D models, all that fun stuff. If you go to, a new home source or Redfin even, you'll see a lot of our, or you'll see a lot of new construction but builds. But yeah, so typically at the drywall stage, it takes about, for a 14 home subdivision, about 3 to 6 months to finish those sales. So it's happening in parallel concurrently with finishing construction.
So to build 14 homes, how does the staggering of those projects work? You don't, you're not going in and building, okay, I'm going to build the foundation of 14 houses. And then I'm going to do the framing of all 14, and then, go like that. Or is it like, okay, let's get the first one going and we're going to get it to a certain point, and then we start the next one, and then we start the next
Yep.
one. How do you stage those out?
Yeah, so in the case of these 14 homes, we're doing four homes at a time. So it'll be four, 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 and then I guess two, right?
Mhm.
So we'll start foundations on four, and then we're basically ordering material also in bulk, right? So as we go along, we're ordering material in these sets of four, if you will. So while the first four, is in framing, I'm sorry, is in foundations, we're actually getting permits for the second set of four, and everything is basically one step behind. So yeah, so it'll take basically 4 to 5 months to finish a set of four homes. um and so if you kind of stagger that out, if we're starting at about 2 months sort of offsets, that's where we get to about 18 months.
Gotcha. Gotcha. Is that something that you've refined over time, where like you found that there was a different way of optimizing the way you stagger that out? Like maybe you were doing two at a time and you're like, no, there's more, economies of scale with four. And, someone's like, well, why don't we just do them all at the same time? Like,
Yeah,
how did you figure that
yeah,
out?
yeah. No, I think, so there's a lot of facets to construction. One is financing, right? So the way that we're
Mhm.
financing these projects is we're doing a combination of debt and equity. So through Limitless, we source the equity. Say 20% of the overall development budget is coming through as equity, and the 80% is coming through as debt, as a senior debt, right? And so these construction loans, as they're called, are typically set up as kind of like a line of credit, right? So you can actually recycle capital through the this credit, or the debt portion. And so the as we're building homes and as we're selling homes, we're returning capital back to our construction budget that we can then go use for finishing out the rest of the homes, right?
Mm,
So there's some efficiency there that we can do that we can provide by instead of a big bang approach, we can sort of phase it out. It's pretty typical for home builders to do that. Um, and then yeah, that's one of the primary benefits. Um, and then there's also the efficiency of labor, right? From a cost of labor perspective, or just one of the big things in new construction is keeping without getting too granular, is keeping your crews busy, because the best crews want to be busy all the time.
yeah.
And so as a home builder, if you're good at keeping your crews busy, they'll stick with you, right? So uh, you know, uh, a house can only be framed once, but you don't want to frame all 14 houses and say goodbye, Mr. Framer. Sorry, there's no more work for you, right?
Right.
But if we can frame 4 houses at a time, and then he knows, okay, I've got 4 more houses to frame, and then 4 more after that, we're keeping that crew busier for a longer amount of time, if that makes sense,
Hmm.
than doing a big bang
Absolutely.
approach. Yeah.
Yeah, that makes a lot of sense. No, the most valuable commodity, um, if you can call it that, is the labor, right? And so many, fix and flippers, a lot of developers run into these challenges with making sure that their good people are busy so they don't go elsewhere,
Yep.
because you want them to make a good living and you want them to be loyal, and once you find good people, you want to keep them, right?
100%.
Because
100%.
I
Yep.
mean, I've done fix and flips before, and I've been there on a Monday morning when people don't show up, or they do show up late and they smell a certain way, and you're like, okay, I know
Yeah.
what happened last night. And then
Yeah.
before you know it, that person doesn't show up at all.
Yep.
It's just how it happens. So yeah, so taking care of your people is key.
Yep. Yep. Yeah, no, I mean, and that's one thing with new construction, Benson, is it is a pretty multifaceted thing, right? There's material costs, there's labor costs, there's the whole supply chain with both those things. Then there's, end buyers, there's the economy, there's the market, right? So there's a lot of things to sort of keep in check and balance. Um, but to your point, um, your people and that supply chain is one of the most important factors. And frankly, what keeps builders going, there's a lot of home builders who just um, not burn out, but basically shut down after a while because they just can't keep that engine going. And so, yeah, keeping your crews busy, obviously building a good product, is all important to keep that flywheel going.
Or a lot of builders using this fundraising model, or are they doing other ways of funding these projects through like more kind of institutional loans, or just bank loans, and not getting money from private investors?
Yeah, great question. So what's happened is a bit of a shift, and to kind of take you back a few years, bit of a history lesson here. So pre 2008, banks would give you basically 100% construction financing. If you walked into a local bank and said, "Hey, I want to build a house or a couple houses," banks like, "Cool, we'll give you 70% loan to finish value." So loan to value being, if the house was going to be finished, finished value is $1 million, they give you 700,000 to construct that home. And if you're a good builder, typically that covers both the land cost and the construction cost. Because if you remember, that 30% profit margin is
Hmm.
300,000, right? So you basically got 100% construction financing. So builders didn't need alternative financing sources. They would just either self-fund for whatever small amount of equity was needed, or friends and family, right? Now switch to post 2008, where banks got a lot tighter with lending and more conservative, thanks to the whole Great Recession and the mortgage debacle, right? So
Hmm.
with loan to cost, now of that 700,000, banks would no longer give you $700,000. They'd give you 80% of that 700,000, which means you have to come up with 140,000, or 20% of your own skin in the game for the bank, to have, be more conservative, right, in their in their lending. So that introduced a capital problem and an equity problem for most builders. So post 2008, you will see there's, if you look at the numbers, over half the builders left the industry and stopped building. And so if you look at the home price appreciation today, part of it is an inflation story. The bigger part of it is frankly uh, a lack of supply. It's an actual supply shortage problem because half the builders are just not building. They're just not there anymore. And so, if you look at new home starts, there's been a sharp drop off, and it's slowly recovering, but we're seeing that lag effect of the last 10 years of no construction, or little construction, because of this capital crunch problem. Because most builders just most lo- 50% of the homes in America today are still built by local home builders. It's not,
Mhm.
D.R. Horton, Lennar, Richmond, Pulte, all these other national home builders are building half the units, but half the supply still comes from local home builders. And so, this capital crunch, that was introduced by the bank pulling back on their financing from LTV to LTC approach, has led to the shortage of supply, which is really an opportunity for us, I believe, as investors and as capital raisers and as syndicators and as funds, and frankly for private equity to step in and shore up this equity gap so that we can get builders building again, improve the housing supply, and ideally one day we're bringing down the cost of housing instead of driving it up, right? It's classic supply demand um, curve, if you will.
So pre 2008, just the average private investor wouldn't have any sort of opportunities in new construction unless they were starting it themselves. There wouldn't be an opportunity to invest with a Lennar or with a D.R. Horton because they weren't looking for private money. They were getting it all from banks.
Yeah, I mean, obviously there would have been the opportunity to invest in a public stock. Like if Lennar was offering stock, 100%, you could just go buy their stock, but you're not getting direct equity into the project itself, which is the most rich equity, if you
Right.
will. Right. So yeah.
That does make a lot of sense. Um, I don't want to get off this too quick, but while we're on the topic, like, are you are you putting all your own money into like your own deals, or are you diversifying into other either asset classes or other investment opportunities like crypto or maybe you're investing in a REIT? Are you diversifying that way, or are you doubling down on what you guys are building here?
Yeah, and great question, Benson. Happy to be as transparent as you like. Yeah, no, we're actually all in. We're into new construction. I actually have very little money personally, or my family does, into the stock market, or actually I own pretty much no crypto. Yeah, no crypto, no, very little in the stock market. It's basically all
Mhm.
into real estate and new construction, and primarily because I'm not going to risk my investors' capital if I'm not risking my own. So. I'm invested in every deal and that we do as a fund. And yeah, this is personal. So
Yeah,
yep.
I mean, you believe in the models, and if you can get those kinds of returns, you're not going to get that. Like maybe you invest in one of these crazy coins that come out, every other
Yeah.
week that
Meme
everybody
coin or
loses their
whatever.
money in. I
Yeah.
mean, those are the only other opportunities besides maybe like startups, which you're familiar with, but those are
Yeah.
rare to make any money.
Yeah.
So like you found the cheat code basically, and you actually get a hand in it. Like in the stock world, that's called insider trading. But in this world, you can actually control what happens with your money, which feels like cheating sometimes, doesn't it?
Yeah, it does. I mean, yeah, I mean, I think there are plenty of good investments out there, Benson. I'm sure you've seen a lot of them too. And it's not to say new construction is the holy grail or the only thing out there. But I do believe it's a fundamentally very strong asset class. America needs a lot more housing. By some estimates, between 4 to 5 million homes short. I'm sure you've probably seen some of the headlines. So I think at the moment it's a great investment opportunity. Um, and I mean, there's a cycle to everything. right? But I think we're in a very like for the next 1 to 2 business cycles, I think it's going to be a very good place to put money.
Hmm.
And it's interesting. Steve Jobs was actually known to say not to diversify. Like he actually believed, for example, diversification was more of a distraction. I mean, he actually had his entire net worth in Apple, right, in the company that he built and created, right, and obviously did very well for it. Um, but yeah, like that's why we're going all in, and yeah, it's been paying off, and there I think there's a lot of upside here in new construction.
Let's compare like two fund strategies, right? So we got new construction with the kind of returns that you can get, and then
Yep.
the alternative of another fund, which is going to do some standard, waterfall with like a 70-30 split, um, maybe 8% pref, and then kind of a standard distribution model. Like what would be the return difference, like compared to like what you can offer versus what you're going to find from a typical like multifamily fund?
Yeah, I think, there's a couple differences. We actually do offer a pref in our latest version of the model, Benson. The difference is
Mhm.
that our pref is accrued versus being paid. So like, we're still doing an annual pref of, I think it's 8% for our fund. So it's 8% accrues annually, but it's paid at exit because obviously new construction doesn't cash flow during construction. So you're still getting the first 8 or 16% is coming off the top, just like a pref for any other fund. But a couple differences being in our case, shorter time frame, so 2 years versus say 5 years, or
Mhm.
whatever multifamily might be, 5 to 7 years is a typical exit there. So
Yeah.
shorter time frame. So typically we're 2 max 3 years. Um, and then um, and we're doing a profit share as well on top of the pref. So investors get to share a lot of the upside as well. We're doing a 50-50 profit share on top of the 8%. And then the combination of those two, the combination of the 8 pref plus the 50-50 is what gives you over 50% returns in 2 to 3 years for our projects.
Yeah, it's pretty good. At what point, maybe you won't ever do it, but is there any sort of efficiencies in transitioning from single family to multifamily new construction? And
As an investor, or do you mean as
well,
a
as
as a
as
fund? Yeah,
as your strategy here, like think, okay,
yeah,
we got to build all these separate things. We got to stage them out or stagger them out, and we got to, move the
yep,
money from one to another. Why not do an apartment building next time?
yeah. So we're actually getting a lot of interest in what's called built to rent. So today we're doing a lot of
Mhm.
built to sell. Built to rent is definitely kind of a big interest area, and it's something that we're not uh, opposed to. In fact, we are looking at several projects like that coming up in our pipeline. The earliest one, for example, is going to be closing in June, July timeframe. It'll be 26 townhomes, apartment townhomes. So these are garden style, side by side, 3 bed, 3 bath, 1,800 square foot townhouses, which do really well here in the Seattle area. And the
Mhm.
idea is that we can rent those out and then, leverage things like cost seg depreciation and other, methodologies to improve our capital gains benefits, maximize the tax efficiency, and then we turn around and sell them in say 5 to 7 years, right? Like a typical multifamily. And the benefit of us doing that approach is that we're building these, for example, at 200 square foot, as mentioned, and you know, once we finish construction, they're at 325, 350 a square foot. So, instant, 30-40% equity. And then the appreciation over the next 5 years should push that even further north. So, it built to rent's a great model. We're looking at that. I think it just comes down to what the investor wants. So a lot of one thing I've been seeing personally in fundraising is a lot of investors are looking at the general market and the economy from a risk perspective and wanting shorter time frames. So I'm getting a lot of, comments and feedback from investors that, as great as the asset or the investment opportunity might look, 5 to 7 years is a very long time in today's world. Like two is
Yeah.
the new five, I think, is what I'm hearing. Like 2 years is the new 5 years. And investors are less patient than they used to be for that return. So we have been favoring build to sell because it provides that quicker return, a quicker ROI versus a build to rent model.
Yeah. Yeah, that makes a lot of sense. There's so much volatility out there in the world, and there's not as much predictability as there once was. So yeah, it makes a lot of sense that that shorter time period is more
Yep.
um I don't know, advantageous, but people are looking for it more, and they're not finding it in the fund world. Are you seeing it anywhere else besides new construction?
Personally, I'm not, Benson, and I think a big part of that is, we obviously saw a rise in interest rates, drop in cap values, and so, I think some of these other assets or real estate assets are taking a while to sort of recover, if you will. So the deals just need more time to sort of season and to recover some of those values and get a meaningful ROI out of it. So that's why I'm bullish on new construction. Obviously the big caveat is making sure you have a good developer and a good builder you can stand behind
Yeah.
and all that. But as long as you have as long as you buy the land right and you have a good developer, it's pretty hard to lose.
Yeah. Well, it sounds like you guys are proving the track record here. How many homes have you built so far to this point with this model?
Yeah, so we're currently under construction on 40 homes. And that's about 33 or so single family homes and about seven condos. And
Hmm.
that's here in the Seattle area. Prior to me joining up with my developer, he's constructed several dozen units himself with, past syndications and individual investors. And he comes from a family of construction. His dad came here in the 70s, 80s. So he's been building for the last 35 plus years. And so my partner, Kevin, has been taking over the business, basically, defending business for the last 10 years or so. Um, but yeah, so I guess several dozen units. And then our model actually is to partner with developers. So while today we're focused primarily with this developer in the Pacific Northwest, we are open to partnerships with experienced developers. So, Benson, if you know of any good developers, let us know, because we do technically have this sort of joint venture approach. So we'll
Mm.
partner with experienced developers and be that funding source, equity and or debt, um, and bring that to a experienced developer today.
I was actually just thinking that because it feels like with the size of your current team and the way you're staggering stuff out, like you can't build fast enough for as many people who are interested in investing with you. You probably got a lot of money sitting on the sidelines that you can't deploy.
Yeah, correct. And yeah, no. I think that's actually a topic I was just talking about with my team earlier today, Benson. Yeah, we're looking to expand the scope of our developer, I guess short list, if you will.
Hmm.
And we're obviously we want to be smart about the area and the asset class. There's a lot of interest right now, for example, in self-storage, a lot of interest in build to rent, multifamily. Um, and there's even prefabs coming online. So there's, if you've heard of system built or prefabricated homes, not modular. People get those confused all the time. This is not modular, but
I
but
was thinking modular. Yeah.
you were okay. There you go. Yes, yeah.
Yeah.
So prefab, the idea is that you're shortening the construction time from 6 or 12 months down to say 4 to 6 weeks, because
Mm.
you have walls, windows, drywall, it's all prefabricated, and then they're brought on site and they're stitched together versus being built, if you will.
Right.
But they're traditional, stick built values. Banks, look at them as traditional stick built homes. They're just fabricated much faster. But anyways, so a lot of the other, carefully evaluating each opportunity, and obviously each developer as well. But to your point, yeah, we are expanding that scope as far as construction goes.
Got it. And what's the name of your company that builds these?
Yeah, so our fund is called Limitless Real Estate Fund.
Mm-hmm.
And then the home builder here in Seattle is called Voyager Development.
Voyager Development. Okay, that's what I was looking
Yep.
for.
Yep.
Very cool. Well, Shawn, you got so many cool things going on. And I know there's people here that are listening and are thinking, boy, I like the way those numbers sound. Um, but they sound too good to be true, right? So how do you dispel those fears of people who are like, this sounds too good to be true? Like no one else is talking about these kinds of numbers. How do you talk to those people and show them that these are actual real numbers?
Yeah, I mean, I would say schedule a call. I'm
Yeah.
happy to walk you through. Numbers don't lie. I mean, I can show you our actual construction budget for these homes and the actual sale prices, and you know, 2 plus 2 equals 4, right? So I
Hmm.
can, happy to, schedule a call is what I would say, the short version, and happy to walk you through the budgets and the actual pro formas and all that fun stuff. And frankly, it's not, you know, um, going back to a bit of the history piece here, Benson. Developers were used to keeping most of the profits for themselves, frankly, just to be put it out there, right? So they were funding these themselves or friends and family, and they would keep these 50% ROIs for themselves, right? Because why would they share, right? But now, when equity capital is at a bit of a premium and they need that to actually scale, what we're doing with Limitless is we're offering, developers have been building at 65-70% of finished value and having these 34 and enjoying these 30-40% profit margins for hundreds of years, right? We're not changing that. We're just giving access to that to our investors today. And in return for providing equity capital to scale to these developers, the give get, if you will, is that they're giving up more of the pie to our equity investors. So we're not doing anything that's rocket science or that hasn't been done. We're
Hmm.
just providing access, to this opportunity.
I love it. Well, Shawn, this has been great. I really appreciate you taking time and being with us and sharing, your background and, this cool model that you're doing over there with Limitless. Thanks again for being here. I really appreciate it.
You're most welcome, Benson. It was a pleasure. I really enjoyed it. And yeah, if your audience would like to get in touch, you could find me on LinkedIn, Shawn George, or you can go to our website, limitlessnewconstruction.com.
LimitlessNewConstruction.com. We'll make sure to put that
Yep.
in the show notes for anybody that's interested. Reach out to Shawn. Take advantage of this, you guys. Obviously, he's looking for more builder partners too. So if you're a builder out there and you think that you guys can spend Shawn's money well, reach out to Shawn as well. But thanks so much for listening, everybody. I really appreciate you guys coming and listening to Shawn's story, and keep an eye out for more really cool guests like Shawn George here in future episodes of the REI Hacker podcast, where we talk about real estate investing and entrepreneurship and business. Thanks for listening. We'll see you all next time. Take care.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.